Welcome to the Transparent FX Academy. I'm Nick and I'm a top author in TradingView with over 190k reputation points. In today's video, I will be speaking about trend trading and how you can implement the concepts that I will speak about in this video to develop a good forex trading strategy. So without further ado, let's get straight into it. The first concept that we have to clarify when it comes to trend trading is that every single time frame in the market will have its own trend. It's very common, and actually it's exactly how the market works, to see that, for example, on the monthly time frame you will have an uptrend, but then on the exact same chart you look at the 4-hour time frame or the 1 hour and you actually see a downtrend. This is a very common thing in the market and is actually exactly how the market moves. So every single time frame in the market has its own trend. Now, for example, just to clarify this concept, let's see here on this chart what kind of different trends we have on the different time frames. And this is an important concept because later on I will show you how you can implement the theory behind this concept to actually develop a potential trading strategy. So here on the monthly, for example, we can see how clearly we have an uptrend, right? The market has just broken above the previous high, therefore creating a new higher high. Now, by definition of an uptrend is a series of higher highs and higher lows. And this is exactly what the market has just created here, creating a higher high, therefore establishing a monthly uptrend. Now, even though here everything is very bullish, right? We can see that clearly that the market has just created a massive move to the upside and it is in a clear uptrend. If, for example, we drop down on another time frame, for example, the 1 hour, what we can clearly see here is that even though on the monthly everything seemed just straight up, here on the 1 hour we see a completely different price action. In fact, we can easily notice how the market was actually in a downtrend from a 1 hour perspective and has actually just started to move again in an uptrend. And we can see that actually we had multiple downtrends from a 1 hour perspective, while on the monthly, clearly everything was just going straight up. So this immediately shows you that multi-time frame analysis, so looking at the same exact pair from multiple time frames, gives you the possibility to understand which is the long-term trend, which is the medium-term trend, and what is the short-term trend, depending on which time frame you're looking at the market at. So if you're looking at the market from a monthly perspective, then clearly you will have the long-term view of that specific pair. If you look at the lower time frames, you can actually use the changing trends from a lower time frame perspective to trade in the direction of the longer term trend. And I will now show you this in more details because clearly I guess that it can be a little bit confusing as a concept. So let's take again, for example, this chart. Now, what we can easily see here is that at the moment, as we just said, we had this very big move to the upside. Now, let's dissect this move to the upside, going all the way from the higher time frames to the lower time frames. So to do that, what we could easily do is draw a box here, okay, this blue box. Now, why am I drawing this blue box? Because this will easily give us the possibility to see also on the lower time frames what exact price action the market was showing inside of this move. So I just want to select this move so that we can ignore everything else and just concentrate on this move to the upside and see all the trends that the market has created inside of this move. Now, starting here on the monthly is very simple. We just have 3 straight candles to the upside, all green, clearly an uptrend. Let's go down on the weekly. Now, here in the weekly time frame, already we start to see something a little bit differently. In fact, we can see that during that same move to the upside on the monthly, we actually had a couple of red candles. Here, we actually went from creating lower lows, so actually a very short downtrend from a weekly perspective here, to then creating higher lows and higher highs once again, establishing a weekly uptrend, therefore following what we already had from a monthly perspective. Going down on the daily, what we can see. Now, here on the daily time frame, in this same move that we had on the monthly, which was just 3 straight candles, we can see that actually from a daily perspective, we had several downtrends. Here, clearly we were in a downtrend. Then we had here horizontal price action with a range. Now, a range is created when you don't have the creation neither of higher highs nor of lower lows. Therefore, you just have a market that is moving sideways, bounded in a range, which is in fact exactly what we see here, the market moving sideways, bounded inside of this range. Then we had the breakout away from the range. The market created a series of higher highs and higher lows, so impulses and corrections. Then once again here, we moved inside of a range. Then we broke out of the range with this impulse. After the impulse, there was the correction, so higher high, a higher low, another higher high, another higher low, another higher high, another higher low, and again the continuation to the upside. So in that same move that we had on the monthly, just 3 straight candles to the upside, on the daily we had 2 ranges, 2 uptrends, 1 downtrend. So we can see how much price action the market has actually created in a move that on the monthly actually seemed very simple. And just bear with me a little bit more, because by the end of the video, you will start to understand how all these concepts actually can be very helpful in identifying trading setups in the direction of their higher time frame trend. Now, if we go down on the 4-hour time frame, for example, and when we go down on the 4-hour, immediately we're now going on the intraday timeframes. Now, the intraday timeframes when it comes to swing trading can be very interesting when it comes to the entry side of the market, because when it comes to identifying direction from a swing trading perspective, monthly, weekly, and daily, those are the best timeframes. When it comes to confirmations and entries, the best timeframes are the intraday timeframes, so 4-hour and lower. Now here in the 4 hours, we can see how clear this shift is from an intraday bearish to an intraday bullish market. Now, we can see that we had countless downtrends and uptrends created in sync with what we had from a higher time frame perspective, so monthly, weekly, and daily. Now, when it comes to day trading on the other side, already the daily time frame can be very interesting when it comes to the directional side, and then 4-hour and lower when it comes to entries. Actually, it's best to go lower than the 4-hour when it comes to day trading from an entry perspective in order to identify those turning points a little bit quicker. And this brings me to why we have to look at the lower time frames. The reason for which we have to look at the lower time frames is because when it comes to the uptrend, if you have a big uptrend on the monthly, you will see a straight line. On the weekly, you might see a couple of corrections, as we have just seen. On the daily, you will see a lot of movements, potentially also some ranges, like we have seen, and anyway, you have a lot of movement. But on the 4-hour time frame, you will have massive amount of movement, right? You will have a lot of price action. Now, if you know from the higher time frame, as we have seen in this case, that we have a big uptrend, on the weekly, for example, if the market starts to move to the downside, you know that you are in a correction from the bullish uptrend that you have on the monthly. On the daily time frame, you will have even more of a correction. You can use the intraday time frames where you have a lot of price action to detect in advance when the market is starting once again to move in the direction of the initial trend. I hope I'm making sense here, but to clarify this concept even more, I will now go on an actual chart to show you in practice how you can use this specific concept. Let's take, for example, here, what just happened on this pair, right? What just happened is that if we take this area of price here, you had a market which was moving in a correction, right? Clearly, I'm using here the reply tool. We had a correction. From a daily perspective, we could clearly see that we had an impulse and the market had just started this correction. Now, this correction from a weekly perspective can't really be seen because everything on the weekly time frame was very bullish, right? On the monthly, we know that clearly we are in an uptrend. So we know that we are in an uptrend on the monthly, okay? We know that we are in an uptrend on the weekly, with the market clearly creating a series of higher highs and higher lows. On the daily, we know that we are in an uptrend, right? We know that because the market is clearly creating higher highs and higher lows. However, we are in a correction. Now, from a 4-hour perspective, what do we know? On the 4-hour, that is the first time frame on which you actually have a different trend. You have a downtrend, you have a bearish trend with the market creating lower lows and lower highs. So monthly, weekly, and daily bullish, 4-hour bearish. Now, when the 4-hour shifts from bearish to bullish, okay, which is exactly here, basically when the market breaks above the previous high, that is when all time frames are actually showing the same direction, which is bullish. So you have a bullish uptrend on the monthly, weekly, daily, and 4-hour. That is where the market has the higher probabilities of creating the continuation because all time frames are aligning in the same direction. And in fact, we can clearly see that that is what the market did. The market created a continuation to the upside following the trend that we had on the monthly, weekly, daily, and at this point, also 4-hour time frame. And that is why when I say that we can use the lower time frames, so the intraday time frames, to understand when the trend is ready to follow once again the trend of the higher time frames, it's a good idea to look at the intraday timeframes. Now, if you enjoyed this video, make sure you smash that like button and comment below. It really does support the creation of more free education analysis for all of you because obviously it helps with the YouTube algorithm, and I will see you in my next video.